Canadian consumers denied tariff war uncertainty last month with the biggest spending growth since the holiday season. The advanced estimate from Stats Can today suggests retail sales rose 0.7% in March. So let's dig into that with Robert Kavcic. He's a senior economist and director of economics with BMO Capital Markets. Thanks for joining us today.
Absolutely. Thanks for having me.
We don't have the details, but what is your read so far on what consumers were doing in March?
I don't know the details. The early read is actually pretty solid, up 0.7. That's a pretty good turnaround from the last few months. And I think we already know that that was a pretty strong month for auto sales too. And there's quite a bit of distortion in some of the economic data coming into this period of the trade war and the uncertainty that surrounded that. So I think as you kind of peel it back, when we actually get the details beyond the headline, auto sales are up quite a bit. You're going to start to see some more underlying softness in areas outside of autos. And as one example, we saw the sales tax holiday come off in the middle of February as well. So there might be a little bit of a give back on that. And then bigger picture is as we got through March and especially into April, and this is where things really start to matter, consumer confidence really started to fall off, just given what was happening on the trade war front and what was happening with equity markets really starting to come down into April. So that's arguing for a little bit more softness going forward.
Yeah, I think also that's when people started talking about the possibility of seeing a recession across North America. So how does what we've seen so far from March compare to what was happening in February?
Well, not too much of a change for the overall picture. You're going to see these monthly retail numbers swing around quite a bit. Auto sales, as one example, did come back in March. And then the distortion of the tax holiday kind of swung or shifted some of the spending around. As I said, though, we can look back at the first quarter, and that is really an artifact of history, right? Because we're looking into Q2 and Q3, and we're looking at the impact of the trade war on consumer and business confidence. And that's where we're going to really probably start to see some of that filter through into the real economic data. Just given the timing of that data, we don't have a lot of hard evidence on the ground that was starting to hit. But if you looked at some of the softer data, the Business Outlook survey, the Bank of Canada surveys, consumer and business confidence generally, we are starting to get the sense that there's some holdback going on there, and we should start to see that as the Q2 numbers roll out.
Okay, so let me sort of take a look, because in February we saw that new car sales were down. You said there might be a bit of a bounce back there for March. I'm just wondering, sort of, is it just big ticket items you see that are going to be sort of left aside moving forward as that uncertainty carries on, or a general spending you think will be down for a lot of retail items?
Well, so on the big ticket front, the funny thing coming into 2025 is we actually had really strong momentum in the Canadian economy, and especially in discretionary consumer spending, even areas like housing. Interest rates were down. The Bank of Canada was cutting rates. And we saw through the second half of 2024, almost 5% annualized real growth in consumer spending, and strong real wage growth as well underpinning that. So there was a case to be made for firmness in discretionary consumer spending, bigger ticket items. You saw that reflected in areas like autos as well. The question now is how much are consumers going to pull back? And it's a little bit early to see that in the data, but we suspect that we're probably looking at much softer underlying consumer spending growth trends going forward, just as we see that caution kind of pervade through spending patterns. And the evidence is there on the ground. Consumers are feeling stressed out right now, right? We see that in the survey data. It takes a little bit more time to actually show up in the real spending numbers, but we're getting pretty close to seeing that, I think.
There's also been discussion as to whether or not consumers were trying to stock up on some things that they thought were going to go up in price. The way we saw some of the shippers and manufacturers push inventory back and forth across the border to make sure that they wouldn't have to pay tariffs coming in or coming out. Are you seeing any indication of that yet?
Well, you see some signs of that in the trade numbers as an example, right? Like imports kind of spiking and inventories getting built in advance of tariffs, especially on the U.S. side. On the Canadian side, autos are probably one example of that, where really strong March numbers might be just a little bit of front running on the expectations that, hey, we're not sure exactly what the outcome is going to be here, but there might be a price distortion coming down the road, both on new and used vehicles. So some of the kind of ramped up activity in March might reflect that in advance. Yeah, I think that's fair to say.
Okay, so what numbers are you going to look towards to confirm what you think is already going on in the next sort of month or two?
Well, so we have the confidence numbers in hand. We're going to be looking to see, I mean, first and foremost, what's happening with hiring. Those are pretty timely economic data in Canada. So if we do start to see more evidence that hiring is really stalling out, and there's already some early evidence on the ground there, that would be a red flag. Just continued downward pressure on things like hiring intentions and spending intentions. We have pretty timely information on that from the likes of the Bank of Canada, and ultimately that does translate into GDP growth. So GDP growth is one good example where February is going to look pretty soft-ish, but not overly terrible, probably slightly below zero. When we look out to March, April, that's when I suspect you're going to start to see some of the more negative prints roll into the second quarter. And again, we don't have those forecasts fully filled out yet with the monthly data flow, but over the next couple of weeks, we should start to fill that out. And I suspect you'll start to see more downside get built into Q2.
We also had the Bank of Canada hold the rate as opposed to cut it, as you had mentioned at the top. They've been cutting for quite a while now. Do you think that factored into people hanging on to their money, or do you think that people are going to hang on to their money anyway, given the trade war? And do you think if the bank does end up cutting later in the year, that could change things really?
So the bank's in a tough spot, right? Because they have to be a little bit careful with respect to easing, just knowing that there's an inflationary impulse potentially coming at them, right? And they're an inflation targeting central bank. And it's a matter of the Bank of Canada balancing the risk of the downside to economic activity versus any upside on inflation. What have they told us? And they've told Canadians, look, this is a pretty uncertain period. And what we're going to do is we're going to look at the data that we have in hand and we're going to react accordingly, right? And oftentimes the bank will move a little bit based on what their forecast says. But in this environment, it's like, we're looking for hard evidence. And the hard evidence they had when they paused at that last meeting was some pretty sticky inflation numbers, but not a whole lot of evidence yet on the growth front because of some of the factors we talked about, right? It's just a little bit soon to see that filter in. So as forecasters, we make a judgment call on this. And our judgment call is that as we go over the rest of the spring and into the summer, we are in fact going to see the growth numbers weaken to the point where they start to overwhelm any kind of upward pressure on inflation. And the bank will go ahead and cut rates 75 basis points further over the course of the rest of the year. Is that going to be enough to trigger a big rebound in housing or an acceleration in consumer spending? Probably not, because that's also set against the backdrop of what's going to be quite a bit softer economic and employment conditions, at least through the middle part of 2025.
All right, I do have to leave it there. Robert Kavcic, appreciate you joining us today. He is the senior economist and director of economics at BMO Capital Markets. Thanks for your time. Coming up next.